Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come, because you're not going to get 500 great opportunities.
So what kind of great opportunity is Warren Buffett talking about here? Well, what if I told you that there exists a simple investing strategy that can make you money without you having to do any work at all? You can literally sleep in every day and spend your days watching Netflix and scrolling social media and still never run out of money? Lucky for you, such an investment exists, and it's been right under our noses. Dividend investing.
I do believe in dividends in a great many situations, including many of the ones companies in which we own stock. The test about whether to pay dividends is whether you can continue to create more than $1 of value for every dollar you retain.
I know what some of you are thinking. It's not sexy. It doesn't sound as cool or as lucrative as investing in hot AI startups or buying Dogecoin and hoping it goes to the moon. But it makes money. Warren Buffett has taken advantage of this for decades, and it's made him one of the richest men on the planet. And if you follow the dividend investing strategy that I will highlight in this video, you can enter 2025 with a much heavier wallet. So let's get started. First things first, what is dividend investing? To put it simply, dividend investing is a strategy where people buy shares of a company's stock, and in return, the company pays them a portion of its profits, known as dividends. These regular payments provide investors with a steady stream of passive income, allowing them to grow their wealth over time. Dividend investing is one of the most searched for methods of earning passive income on Google and YouTube, and there's a reason for that. Anyone can do it. You see, unlike real estate investing, which typically requires having tens of thousands of dollars to make a down payment, you can get started with dividend investing with literally less than $100. So even a college student or a single parent can get started with dividend investing and slowly contribute larger amounts to their portfolio over time.
But with public companies, a lot of people do buy stocks to obtain dividends, and they hope for regularity, and that there's a signaling aspect to it and everything.
As Warren pointed out in this clip, investors love purchasing dividend stocks because they provide a very steady stream of cash flow. Now, before I continue, you need to understand the difference between the two main types of income: active income and passive income. Active income is money you earn by working and trading your time and skills, like a regular job. Passive income, on the other hand, is money earned with minimal ongoing effort, typically generated from investments or assets you've created, and it continues to make money even when you're not actively working. The key to financial freedom through investing is to slowly siphon money from your active income into your passive streams of income until your passive income matches your active income. At this point, working your job becomes completely optional. A great example of passive income would be a side hustle that I recently discovered, which can make you thousands of dollars per month and requires only a few hours of work every week. To learn more, click the link in the description for a free guide. Now let's try to figure out how much money we need from dividend investing to cover all of our living expenses so we never have to work again. I'm going to use Coca-Cola as an example since we're all familiar with it. As some of you might know, Warren Buffett is a proud supporter of Coca-Cola and owns a ton of the company's shares. This is great for his investing portfolio, since Coca-Cola is a very stable company that has been around for a long time, and it's also loaded with tons of excess cash, which is music to the ears of every dividend investor. Generally speaking, a company like this has three options for what to do with their excess cash: save it for emergencies, reinvest it into the company, or pay it out in dividends to shareholders. Since Coca-Cola is so well established, using the money for anything other than paying it out to shareholders would be kind of stupid. Take a look at what Warren Buffett thinks about this tactic and the company that he owns which uses this tactic.
Take See's Candy, which we own. See's Candy has paid everything virtually out to us that they've earned because they do not have the ability within See's Candy to use large sums which they earn intelligently in their business. So it'd be an enormous mistake for See's Candy to retain money. So they distributed Berkshire, and we hope that we move that around in some other area where that dollar becomes worth $1.10 or $1.20.
Going back to Coca-Cola, they have a very long track record of dividend payouts. As of recently, they have a dividend yield of about 3.16% annually. Dividends are usually paid out every quarter, meaning you'll get payments 4 times a year, which is nice. But how much money can you expect to get from Coca-Cola if you have just one share of the company? As it stands, if you bought one share of Coca-Cola, you'd get paid $1.84 in a year. That's pretty lame. But what if you had 10 shares? Now that number turns to $18.40 per year. Okay, let's pump up these numbers and see what happens.
I pump those numbers up. Those are rookie numbers in this racket.
So what if you owned 1,000 shares? Now you're looking at $1,840 a year. So to make up to $3,300 a month, you'd need a total of $1.29 million invested. Before you get intimidated and give up, hear me out. I have good news. The great thing about the stock market is that there is always movement, and movement equals opportunity. Companies are always moving either up or down, but a good company like Coca-Cola will generally appreciate in value over time. As a company grows, so does the money you have invested, and the dividend grows with it too. For example, the dividend payout for Coca-Cola in 2013 was only 28 cents per share. And now it's 46 cents, which is almost double. That's not mentioning the fact that the share price has also risen 60% since 2013. To ease your worries, here is an amazing quote from Warren Buffett on investing. Yeah, that's literally all there is to it. The hard part for most people is just staying patient and not making dumb emotional decisions. Now you might be wondering if there are some other options that could speed up the process. Fortunately, there are. Let's look at some of the stocks that Warren Buffett currently owns and their dividend rates. I've already touched on Coke, so let's look at some others. Citigroup Bank currently has a dividend rate of 4.04%, which means that you would need approximately $990,099 if you want to make $40,000 per year or $3,300 per month. Another company is Vitesse Energy, which has a current dividend yield of 8.68%, meaning you would need $450,000 to generate $40,000 a year. At this point, I'm sure some of you have already come up with a strategy for hacking dividend investing and getting rich much sooner. You're probably thinking that the best way to make this work is to find the highest paying dividend stocks and go all out on those, right? That's a bad idea. When you invest in dividend stocks, what you actually want is to get the most value for each dollar you invest. And just because a company offers high dividends doesn't mean you get high value per dollar.
The test about whether to pay dividends is whether you can continue to create more than $1 of value for every dollar you retain.
While the high yield seems really attractive, more often than not, these high yields aren't sustainable by the companies offering them. It's also not uncommon for these types of companies to be on the verge of bankruptcy. Imagine that you have a bunch of money in a company with a really high dividend yield of 10%. You're collecting your massive payouts, but later in the future, the company goes totally bankrupt due to poor financial management. Clearly, this is not your fault, but you end up losing all your money anyway. The moral of the story is that while high dividends may seem attractive now, they're usually hiding something that they don't want people to know. If you ever get lost, remember this quote from Warren Buffett: "Time is the friend of the wonderful company, the enemy of the mediocre." But maybe you don't want to invest in stocks because of the research it requires. Worry not, there's another wonderful option for you: ETFs. ETFs are essentially a selected basket of stocks that are sold as one group. There are all sorts of different ETFs, but I'll focus on 2 for now. Consider VYMI, an ETF that primarily focuses on companies with high dividends. At the current rate, it offers a dividend yield of 4.04%, which would require an investment of approximately $990,099 to generate $40,000 per year. Another alternative is FVD, with a dividend yield of 3.6%, necessitating an investment of around $1,111,111 to reach the same $40,000 annual income target. While ETFs require less research, it's still a good practice to conduct a quick Google search on the listed companies for a better understanding of your potential returns. For investors, particularly those interested in real estate, consider putting your money into real estate investment trusts, also known as REITs. REITs operate much like stocks. They are publicly traded companies on the stock market. However, there are key distinctions. These companies exclusively invest in real estate, providing you with indirect exposure to the property market. Additionally, they are legally required to distribute 90% of their earnings to shareholders, resulting in substantial dividend payments. Take, for example, XLRE, boasting a robust dividend yield of 7.44%. To achieve an annual income of $40,000, you would need an investment totaling $520,000. If you're anything like me, you're probably wondering how you can grow your money to $500,000 or more, right? I did say that you could, so let me show you how. Let's continue the example with Coca-Cola. I said that they have a current dividend yield of 3.04%, and you would need something like $1.295 million to make $40,000 a year. However, that's assuming that you put that much money into buying shares today. But that's not how dividend investing works. That's not how Warren Buffett did it, and that's not how you should do it either. Dividend investing is a marathon, and you can do two things to make sure you win. The first is that you continuously put money into buying dividend-paying stocks. That means every month you want to put money into buying shares of Coca-Cola. Let's say you start with 10 shares of Coca-Cola and buy 10 shares again every single month. Over the course of 10 years, you would have an annual dividend income of about $4,000. And if you were to increase the number of shares you bought to 20 a month instead of 10, then you could expect $5,975 in dividend yield, which also isn't anything crazy, but hear me out. There's one more component of investing that we ignored in these calculations, and it's probably the most important factor to help you win much faster, and that's the power of compounding interest. Instead of just taking the cash of your dividends out, put that money back into the dividend-paying stock to grow your money even faster. This is called DRIP and stands for Dividend Reinvestment Plan. So how can DRIP help you make money faster? Suppose you buy 20 shares of Coca-Cola every month for a decade and reinvest your dividends. As a result, you'll start earning an additional $1,000 each month simply by reinvesting your dividend payments into the stock, requiring minimal effort on your part. On top of this, it's important to note that the value of your assets continues to increase over time, potentially resulting in a substantial nest egg that could already be approaching a value of $500,000. One quick note, dividends are considered income, meaning that they are considered taxable income. If you reinvest your dividends, this isn't something to discourage you at all, but you should be aware of this so you're not surprised when it's tax season. But if you hate paying taxes, I made a great video to show you how to legally avoid paying taxes just like rich people, so you can check that out after this video. So to live off your dividends, you need to follow the following steps. Number 1. Determine your investment choice, whether it's stocks, ETFs, or REITs. Number 2. Ensure that you automatically invest any income you receive into your chosen investments. Number 3. Always reinvest your dividend earnings, allowing your money to grow and generate more income for you. Number 4. Keep in mind that you are obligated to pay taxes on the dividends you earn, but there are legal ways to reduce your tax bill. Now, if you're interested in making serious money every month within just 1 to 2 years instead of waiting out the stock market for 30 or 40 years, you should consider starting a passive income side hustle. Ideally, this needs to be something that you can do while keeping your main source of income, such as a job. I found the perfect side hustle that 99% of investors have never even heard of. If you want to learn more, click the link in the description to get all the details.